D Subbarao, Distinguished Fellow at the Singapore University and former Governor of the Reserve Bank of India, is joining us for an interview. Thank you so much, Dr. Subbarao, for joining us. Let me start by asking you, what do you think are the key mega trends that could shape the Indian economy in the next 2 to 3 years?
First of all, thank you indeed for having me on this show. On the question of mega trends, actually I'm going to give a speech on that topic later this afternoon. The first big mega trend that's going to shape India's future is engineering a manufacturing revolution. Prime Minister Modi has been talking about it. We badly and desperately need a big manufacturing sector in order to generate jobs for hundreds of millions of people. So the first question and first big mega trend is going to be a manufacturing revolution. The second one is going to be decentralization. Decentralization, of course, has been with us since independence has taken root since the 73rd and 74th amendments to the Constitution. But I think it's going to take, get much deeper, in part because the second generation of reforms that this government has to implement need the active cooperation and consent of the state governments. So decentralization, not just to the state level, but even to the sub-state level, is going to be the other key trend. The final mega trend on my list that would shape India's future would be globalization. India has been integrating with the world for the last several years, and that integration is going to get deeper. Notwithstanding the backlash against globalization, the cost we've had to pay, I think there will be realization that globalization comes with costs and benefits, and that in the long run, benefits outweigh the costs. So when I say globalization is going to deepen, what I mean is that India's trade will increase, and even on the capital account, India will become more open.
Well, how do you view the improvement in India's macroeconomic fundamentals that we are seeing? Are they for real and are they enduring, or are they contrived and temporary?
Well, that's a difficult question to answer in a binary sense. But over the last several months since this government has come into office, we've seen macro indicators stabilizing, indeed improving. Growth is on an uptrend, inflation is on a downtrend. There's been significant adjustment on the current account. Fiscal consolidation is on track. Investment sentiment is reviving. All these indicators, improved indicators, will deliver a cyclical upturn in growth from below 5% last year to 5.5% this fiscal year to maybe 6 to 6.5% in the next couple of years. But the question is that sufficient for India, given the size of its poverty, the aspirations of millions of people, the hundreds of millions of jobs that have to be created? We have to grow at 7, 8, 9%. So the challenge for this government is going to be whether they can shift the economy to a high growth trajectory on a sustainable base by the time they finish the current term in office.
So is the success in controlling inflation due to monetary policy, or is it more due to fortuitous circumstances such as the falling oil and commodity prices?
As a former governor of the Reserve Bank of India, I cannot say that the softening of inflation is not due to monetary policy. Monetary policy, especially Governor Rajan's stance, the credibility that is given to inflation control has certainly helped. But I should also add that the fortuitous global circumstances that you mentioned have helped. In particular, oil prices are lower, much lower than earlier estimated. The monsoon has been stronger than earlier feared, and growth possibly might be weaker than earlier expected. All these are deflationary factors, and they, in a sense, would bring the cyclical factors, but the Reserve Bank is going to see to what extent this will sustain, these dynamics will sustain, to what extent they're cyclical and will revert to the mean. So I would say the softening of inflation is both due to the Reserve Bank's credible monetary policy stance as well as fortuitous global circumstances.
So let me put it another way. Is inflation targeting the way to go, or has the financial crisis really raised doubts on the wisdom of central banks focusing only on inflation?
One of the big lessons of the crisis is indeed that strict inflation targeting does not work. Countries, central banks must be more flexible in delivering on their inflation target, which is to say that they must deliver on their inflation target, but subject to concerns about growth and financial stability. So that's been the big shift in policy stance, in thinking post-crisis. In India, of course, we're talking about a new monetary policy framework that will assign an inflation target to the Reserve Bank. I think that's a good move in as much as the Reserve Bank's objective function, indeed what objective the Reserve Bank has been driving, has not been very clear. But having said that, I would also add that it will be difficult for the Reserve Bank of India to deliver on a strict inflation target, in part because as much as 50% of inflation is beyond the control of monetary policy. So I would think that in the agreement on monetary policy framework between the government and the Reserve Bank, it would not be a strict inflation target, but an inflation target that is qualified by concerns about growth and financial stability.
I couldn't agree with you more on the limitations of monetary policy, but then what is the ideal structure of the FSDC, the Financial Stability and Development Council, and the Monetary Policy Committee? Who all should comprise these committees?
Well, first on FSDC, I think the structure as it is constituted now is okay, with the finance minister chairing it, the governor of the Reserve Bank chairing the FSDC subcommittee, and all the regulators and the finance secretaries, senior officers, including all secretaries, represented there. What is of greater importance is how the FSDC meetings, what the agenda is, what the decisions are taken, how they're implemented, and how active the FSDC is. In particular, is it very intrusive? So intrusive that it eats into the autonomy of the regulators? Does it keep itself to financial stability functions and financial development functions? So that's going to be the big issue. And my own view has been that the FSDC must play a more activist role during pressure times, during crisis times. And in normal times, it must relegate itself to the background. On your second topic, item on your question, which is the Monetary Policy Committee, I think the governor must have a decisive say on the members of the monetary policy. Of course, there will be individuals who will enjoy reputation for credibility and intellectual honesty, but on specific purposes and the composition, the governor must be consulted.
Yes, absolutely. The governor must have a very important say in the FSDC. But in a recent interview to ET Now, the FM Arun Jaitley had said that poor credit offtake is something that has really worried him. Do you expect the improvement in the credit offtake, and how much is it linked to interest rates?
Well, certainly credit offtake has been poor, has been quite uncomfortably low. It's difficult to say how much of this is indeed due to the Reserve Bank's monetary policy stance, in particular to what extent the interest rate setting by the Reserve Bank has been a binding constraint, and to what extent other factors are at play. But certainly credit offtake is important for investment revival, both for generating the sentiment in the short term as well as for generating productive capacity for sustainable growth in the medium to long term.
Well, the recent World Bank India report says that India's potential rate of growth is 6 to 7%, and the fiscal balance is also improving. What is your view? Do you see India in a better position than other EMEs in terms of the macros?
Well, first I must say that I'm quite heartened by the number that the World Bank has put out, because during my time in the Reserve Bank, we were quite quite uncomfortable with how low the potential growth rate had come down. We were talking about potential growth having come down, declined to below 6%. So if the World Bank has put out a number that's in the range of 6 to 7%, that's certainly good. I think compared to other emerging markets, India is in a relatively better shape because of the adjustment that is made on the current account, because foreign exchange reserves have been built up, fiscal consolidation is on track. But the important thing really is to use the current breathing space provided by easing global pressures to institute big ticket reforms. And that's also important because the government enjoys an enormous amount of political capital now, so they must get on with reforms early on, so that sustainable results come in by the time they finish their term in office 4.5 years from now.
So yes, we really have a window of opportunity now, but then what are you expecting to hear from the FOMC on Thursday morning Indian time? Is there a risk of fund flow reversal? And do you see India ready for any eventuality of US interest rates going up?
Well, first of all, I should say that I'm not expecting anything, but I can give you my own view, which is that they're going to, now they're going to stop QE, which means that they're going to stop expansion. And at some time in the future, they're going to have to reverse both the QE as well as raise interest rates. How soon this will happen is, of course, a big question. They're going to look at how robust the recovery is. They're going to look at inflation concerns on the way forward. And importantly, they're going to also be concerned about any threat to financial stability as a consequence of keeping interest rates low for an extended period. But my own view is that the reversal of QE and raising of interest rates is going to be later than what most people currently think. That's my own view. As far as its impact on emerging markets, in particular India, is concerned, as I said, India has made an adjustment since last year. When QE is reversed, there will be a hiccup. There will be some capital outflow. There will be some adjustment. But that will be nothing compared to the taper tantrums we had last year. There will be a quick adjustment to a fairly stable equilibrium, I believe.
I hope you're right on that, Dr. Subbarao. But recent steps, a number of steps have been taken, monetary as well as fiscal, and these have helped India to move out of that fragile 5. But what, according to you, is necessary for India to get into a growth 5 rather than be part of the fragile 5?
India has to generate investment. The big task for Prime Minister Modi and his government will be to revive investment, particularly investment in infrastructure. That needs reforms, both structural reforms as well as governance reforms, and also it requires a very healthy financial sector. So moving on with reforms and getting the financial sector, in particular banks, to relative confidence about lending will be quite important.
Absolutely. There's a huge task ahead of the present government. But thank you so much, Dr. Subbarao, for joining us in ET Now and giving us your first interview after you stepped down as Governor Reserve Bank of India. Thank you very much.
Getting me on this show. Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.